Hi, this is Mike Lembeck with Remax Commercial. I just wanted to bring you this week's SoCal Multifamily Sales Pulse. And first off, I want to go over what's happening in the market, and here's what it means to you. This is some headlines, recent headlines that we've seen over the last week, and just wanted to elaborate a little bit more on what exactly this is all talking about, and a little bit more in depth. So the first one is the votes are in delinquent listings fuel California's MLS inventory. And what that's talking about is that not necessarily are we seeing it in the notice of default or notice of trustee sale, but we're seeing the MLS inventory showing the delinquent property tax and mortgage payments. So a lot of the listing agents are reporting that this is one of the reasons why some of the listings that they have, some of the sellers are selling. So something to be alert, and that's again not showing up on the notice of default yet, but payments, they are behind on payments. Next up is the home price correction is sharper and more widespread than previously thought. A growing chorus of research firms, including Moody's, says that the correction will continue into 2023. And that is definitely what's going on. We're seeing prices reduced in some cases by already 5% over the last 3 months, and that potentially could increase into next year. And with more interest rate increases following or coming forward, we're expecting to see a little bit more of a downturn and a slowdown in the market. Next up is multifamily buyers will have outsized opportunities in 2023. It has outperformed other asset classes from a yield perspective, and as the cost of home ownerships continue to increase and many buyers are out of the market, demand drivers will remain strong. So we will see the multifamily buyer having a more significant yield in as far as investment goes for commercial property and even against single family. So the inventory increasing has not been all that dramatic, and that I will go over in one of the stories below. That one of the things that is going to increase our multifamily buyer opportunities is potentially increased rents and increased cash-on-cash return. As mortgage rates rise, the affordability gap widens, increasing the barriers of entry for home buyers and subsequently pushing them towards renting. The shift will provide a strong rental market, allowing rental rate growth to outpace inflation. Again, rents are increasing. They aren't going up as much as they did in the past, but they still are we're starting to see a bit of a slowdown there, but they still are increasing, just not as much as they had been. Okay, next up is the housing bubble woes. Home builders cut prices, pile on incentives amid plunging traffic of buyers, spiking cancellation, and holy moly mortgage rates. Of course, with the interest rates increasing significantly, almost doubling from what they were earlier this year, the builders are having to cut their prices and give a lot more incentives to buyers to not only purchase the properties, but potential buyers that were in escrow to not have to not want to cancel their current transactions. So we're going to potentially, there could be a repeat of 2008, where we saw incomplete housing tracts just sit for years until the market corrected and the buyers came back. And some of these builders may walk away from some of these housing tracts that they're currently developing because of it. Significantly higher mortgage rates are preventing a massive number of homeowners from selling their homes, and the trend has grown more problematic recently. What's happening there is we're seeing homeowners who have had low interest rates of homes that they purchased or refinanced over the last 2 or 3 years, and they're locked into those homes basically because they don't want to exchange out or move down into a home that has a higher interest rate, significantly higher interest rate than where they're at now. So they're just going to stay put, and what's going to change that is potentially mortgage rates going back down to where it makes it more of a financial feasibility for them to actually move out into a different home. Again, the historic low rates of 2021, some as low as 2.25%, caused what economists call the locked-in effect, meaning owners with low rates are likely to stay put rather than move for years to come. That's another headline that I was able to pull with the same effect as the previous. And next up is Fed Chair Powell says housing markets has to go through a correction and calls that a good thing, citing the need for more balance between supply and demand, saying affordability needs to be restored. Again, it's a balance type of thing where supply and demand, but you've also got a balance between buyers and sellers and what buyers are willing to pay and what sellers are willing to accept, and the reality of the prices dropping and significant lack of activity because buyers are pulling away from the market. So that balancing where that's going to end up and how much increases of interest rates has to be done in order to achieve that is anybody's guess. We're anticipating more this year and then into next year. For how long, we just don't know yet. We're just trying to get inflation under control. Next up, the Federal Reserve on Wednesday raised its benchmark interest rate by 75 basis points for the third straight month as it tries to bring scorching hot inflation under control, a move that threatens to slow U.S. economic growth and exacerbate financial pain for millions of households and businesses. So a lot of people, as I'm sure you're familiar with, going to the store and purchasing your groceries, there's a lot of pain and strain on everyone's budget these days, especially some small businesses, restaurants, and other small businesses are starting to feel the pinch slowly but surely. So the average American has lost $4,200 in annual income since President Biden took office, entirely wiping out gains made under the Trump administration. So not only have you lost income, but your cost of your expenses and your cost of living for food, utilities, and the like have all increased. So you're being squeezed in more than one way. And then the last here is most experts point out that the multifamily sector continues robust at this juncture. The market has been very strong and rents have kept up with inflation in many markets, even at the elevated levels of current inflation. So again, multifamily is going to be still a very strong and very good investment moving into the future, even with the interest rates moving up and even with the current inflation. All right, for this week's Pulse of the Market, we've seen an increase in inventory since the start of the year, as most of Southern California has seen multifamily inventory levels up by 30 to 50% since January. Even with the inventory levels up, the number of monthly sales is still about the same level as they were in January. Investors who took advantage of the low interest rates and bought property over the last 2 to 3 years aren't going to be in a hurry to sell or exchange out of those properties and into a new loan at a higher rate. We're seeing fewer pending sales each week. Now's the time for buyers to create good deals by negotiating with more flexible sellers. What to expect? With interest rates almost twice as high as they were earlier this year, the more interest rate increases potentially coming over the next few months, and the holidays approaching, I don't see much to indicate any significant change in the market. If anything, there will be continued slowing. The end of each year usually provides some buying opportunities due to investors wanting to close escrow before the end of the year. If you're selling, let me know if you're interested in an analysis of your property, and as a buyer, if you're interested in buying any one of these potential deals that are going to hit the market. All right, that wraps up this week's SoCal Multifamily Sales Pulse. Make sure you catch next week's video where I'll be reviewing the monthly stats from September that will give us a fresh look at the listing and sale trends we're seeing since the recent interest rate increases started. And don't forget to look at all the past week's closed sales in detail in the full report on my website, SoCalMultifamilyBroker.com. As always, feel free to give me a call or send me an email with any questions on the market. All right, that's it for now. I hope something good happens to you today. See you next week.